So today we're going to tackle a really fascinating puzzle in the world of investing. It's all centered on one company, Cognex. And it's a classic story of a fantastic business that, depending on how you look at it, is either a terribly overpriced stock or a rocket ship that's just getting started. Let's dive in.
See, Cognex isn't just some ticker symbol on a screen. They're a real, high-tech company, and they build the literal eyes for modern factories and warehouses. Their technology is at the absolute heart of how everything gets made, inspected, and shipped in the modern world.
Here's how we're going to break this all down. First, we'll get into what Cognex actually does, its role as the eye of the factory. Then, we'll look at it as a high-quality business. But right after that, we'll hit the big speed bump, the valuation problem. From there, we'll switch gears completely and see how a technical trader looks at it before we land on the big question, the investor's dilemma.
All right, so first things first, what does Cognex actually do? Let's get into the nuts and bolts of their business.
Their whole world is something called machine vision. And what is that? Well, just think of it as giving computers the ability to see. This tech is absolutely critical for, guiding a robot on an assembly line, spotting a tiny flaw in a product that a human eye would miss, or sorting millions of packages in a giant warehouse.
And these are the tools in their toolbox. You've got their insight systems. Those are the super picky quality control inspectors. Then there's DataMan, which uses some seriously advanced tech to read barcodes and track goods. Vision Pro is the software brain that processes all that visual info, and their new One Vision platform uses AI to make it all way easier to set up.
Okay, now let's switch hats for a minute. Let's put on our value detective hat. This is the kind of investor who's hunting for a truly fantastic, well-run company to own for years and years. And from this point of view, man, Cognex looks absolutely brilliant.
First off, the management team is incredibly disciplined. I mean, they pour a hefty 14% of their revenue right back into R&D to stay on the cutting edge. They're consistently buying back their own stock, and a huge chunk of their pay is tied directly to how well the company does. They are laser-focused on what long-term owners care about, generating cold, hard cash.
And this number? This tells you almost everything you need to know about their power in the market. A 67% gross margin. That is huge. It means for every dollar of product they sell, 67 cents is gross profit. That's a blaring signal that customers are willing to pay a premium for their technology.
And what does that incredible discipline and pricing power lead to? It leads to this, a record-breaking $237 million in free cash flow. That's the actual cash left over after all the bills are paid. Money they can use to innovate, reward shareholders, and just make the company even stronger.
But maybe the most impressive number, the most jaw-dropping one, is this: 0. That's how much long-term debt the company has on its books. Zilch. Nada. It gives them a level of financial stability that is just incredibly rare.
The analysis we're drawing from puts it perfectly. It says the balance sheet is fortress-like. I mean, what else can you say? Financially, Cognex is an absolute fortress. From a business quality standpoint, this is an A-plus company, no question about it.
But, and this is a huge but, this is where our story takes a really sharp turn. Because any good investor will tell you, a great company doesn't automatically make a great investment. The price you pay matters, and this is Cognex's billion-dollar problem.
So with the business this strong, you're probably thinking, this is a no-brainer. It's the perfect long-term investment, right? Well, not so fast. And here is the giant disconnect. When you try to figure out what the company is actually worth using a standard model based on its future cash flows, you get a value of around $28 per share. But the market is currently selling it for about $54, nearly double. And look, we're not talking about a small premium here. The stock is trading at more than a 90% premium to what the fundamentals suggest it's worth. For a value investor, that's a deafening alarm bell. There is absolutely no margin of safety, no cushion if things go a little bit wrong.
All right, so let's take that value detective hat off and put on a totally different one. Let's think like a momentum trader. This person could not care less about intrinsic value. All they care about is price action, trends, and market psychology. And from that angle, the story looks, well, a whole lot better.
Now, take a look at this chart. This is a whole different way of looking at things. It's called an Elliott wave analysis. It's a theory based on the idea that markets move in predictable, repeating patterns, or waves, driven by human psychology. And according to this chart, Cognex could be setting up for a very powerful move up.
So to break this down simply, the stock has apparently completed its first two waves, but the really interesting part is where we are now, supposedly in the middle of wave 3. And in this theory, wave 3 is typically the longest, strongest, and most powerful upward push in the whole cycle, with a target price up around $75.
So, what's the bottom line here? While our value investor sees a dangerously overpriced stock, the technical trader sees a stock that's right in the sweet spot of a powerful uptrend. They see a potential move up to $75. It's a completely opposite conclusion, just based on a different set of tools.
And that, right there, brings us to the heart of the matter. You have two perfectly logical yet totally conflicting viewpoints on the same exact stock. This is the investor's dilemma.
So you have the value detective on one shoulder saying, I love this company, but I hate this price. I'm going to wait for it to get cheaper. And then on the other shoulder, you've got the momentum trader saying, the trend is your friend. Let's ride this wave higher. There's more money to be made.
So let's just lay it all out one last time. The pros are undeniable. You've got that fortress-like balance sheet, they're a leader in the booming fields of AI and automation, and they have fantastic management. But the cons are just as serious. It seems wildly overvalued, the business goes up and down with the economy, and its competitive advantage, while strong, isn't totally unbeatable.
And so it all boils down to this one question, a question that really gets to the heart of how you see the world of investing. When you find a truly great company, do you believe in buying quality at any price? Or is the real secret to success having the patience to wait for the right price?